But this is going to provide you the background for understanding why gold is so bullish and why commodities, why it's leading a commodity bull market and why it's going to last for decades rather than just a matter of years.
Tuesday, February 11th, 2025, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Mark Galishevsky from Elliott Wave International. Mark, welcome to the channel.
Thank you very much, Mario. It's great to be here.
Thank you for accepting my invitation. And today, Mark is going to look into Elliott Wave, the Elliott Wave principle, and why he thinks the bond bear market and the commodities bull market are the most important aspects of financial markets for the next few decades. He believes, just like Bob Proctor's forecast back in the late 70s, that we'd have a massive bull market in the stock market. He believes that this could be the next big call. So, Mark, do you want to go over the Elliott Wave principle and then into your thesis?
Sure, very good. I've got a PowerPoint presentation that I can go ahead and start if you don't mind.
That's fine.
Let's see. Let me share this here. Okay. Can you see that now?
You should be, yeah, we can see it now.
Okay, very good. Well, I recently introduced a thesis to my subscribers. It's called The End of the Infotech Era and the Rise of Emerging Markets. There's a transition occurring between the infotech era, as I described it. It's been dominated by the cryptocurrencies and the Mag 7 stocks, the Nasdaq 100. Um, but it's but that era is ending. It may continue a little bit longer. These assets may continue rising a bit longer, as we'll see. But what's happening at the same time, in fact, it already began in the year 2020, are supercycle advances in commodities and interest rates. And gold is features heavily in here because it's the leader of this sector. Gold is the leader of the commodity sector, and what it does, its breakout in 2024, is a leading indicator of the rest of the commodity group. So let's, without further ado, let me get into. But by the way, yes. So the thesis is called "The End of the Infotech Era and the Rise of Emerging Markets." My name is Mark Galishevsky, and I write a newsletter called the Asian Pacific Financial Forecast for Elliott Wave International, which is a U.S. Based financial publishing company.
And just
Um,
wanted to add, Mark, I'm gonna
Please.
put a link to your website in the description. So if people want to look into the Elliott Wave website and Mark, they can do that.
Okay, great. Thank you, Mario. That's wonderful. So the let's first start here with right the relation. Let's before we talk about the end of the infotech sector, let me tell you about why I'm bullish on emerging markets. Here you have gold represented by the Spider Gold ETF at the top. In the middle, the iShares Global Materials ETF, which is an index or an ETF of commodity producers. And at the bottom, the MSCI Emerging Markets ETF, or EEM is its New York Stock Exchange traded symbol. All of these asset classes have tended to ebb and flow with each other for years. And we think that gold's breakout in 2024, as you see there from basically a net sideways trend of the past 13 years, is very bullish for all three of the asset classes, as we'll see over the long term. And while I'm here, though, I wanted to, Mario, I understand that you grew up in Brazil. I stepped out. Currently in Florianopolis, but at last week I was in Rio de Janeiro, and I stepped out and snapped this photograph. I hope I've translated it correctly. We appraise gold, or we evaluate gold. Um,
Yeah,
Not sure. Yeah.
Uh, this is, I haven't been to Brazil in 10 years. The last time I went there, I didn't see that. So I think it's a good sign that Brazilians are looking into gold because usually they resorted to acquiring US dollars or paper money to protect themselves. But I think the dollar is not going to be the place to be. So yeah, I'm happy to see that the Brazilians are waking up to gold. And yeah, I grew up. I was born near Rio, uh, lived in Rio as well, and then I left for university, and then yeah, and then I haven't really lived there for a long time. But yeah, and Florianopolis in the south of Brazil, I've never been to that part of Brazil, but I think it's a nice place as well.
Very good. Okay. Well, let's return to our methodology here. Ralph Nelson Elliott discovered the Elliott Wave principle at the time, and this was during the Great Depression in particular. Uh, Ralph Nelson Elliott was an American accountant who lived and worked in Latin America for a time where he fell sick and he had to come back to the United States. And while he was recuperating, he was graphing the Dow Jones Industrial Average that, the prices that were quoted in the Wall Street Journal at the time. As he was graphing these by hand, these charts, he discovered repeating patterns at multiple degrees of trend, smaller, larger, didn't matter. They were basically playing out the same way. And he called his discoveries at the time the wave principle. In retrospect, Wall Street has since called it the Elliott Wave principle in honor of the founder, the discoverer. And let's look at one quick example of what is a basic Elliott wave pattern. Well, you've got a 5-wave advance in making progress in one direction, followed by a 3-wave decline labeled ABC. And what's a feature of this of Elliott waves is that they are essentially fractal in nature. This 5-wave advance is actually part of a larger structure, as you can see here, as bracket wave 1, what we call intermediate wave 1, and wave 2 is actually the first up-down sequence within a larger 5-wave advance, which is followed by a self-similar decline, a correction labeled ABC. And you can imagine that at one higher degree, here we have, in Elliott terms, it's called primary wave 1, circled wave 1. And you can imagine that there would be a much larger 5-wave pattern that would evolve from this. And so what Elliott was describing, he didn't have the word at the time, but we now know it as a fractal. In this case, a self-similar fractal. Each of the subwaves basically looks like, the larger pattern as well. And this is, fractals are found throughout nature. You have a broccoli stem looking very much like the bunch. You have a branch looking very much like the larger tree. These are fractal relationships found in nature, and the stock market, or at least in financial markets, are no different. That's the wonderful breakthrough that Elliott made. So it doesn't matter what the news is. It doesn't matter what government policies are announced. These fractal patterns are going to play out regardless. And it makes it a very objective way of looking at the market. I am coming to my macroeconomic conclusions from long-term patterns, not because I have an armchair opinion about what gold is going to do, or what the stocks are going to do, or what commodities are going to do. I'm actually formulating my macroeconomic view based on long-term patterns. And let's look at an example of how to do that. I'm showing you India here in October 31st, 2008, because you'll actually see that this pattern that I've identified is relevant to our discussion of commodities later. You'll see here, and I think many of your viewers may already be able to see it, you've got a 5-wave advancing structure followed by a 3-wave decline. Here's exactly, this is right in the belly of the beast, right in the bottom of the global financial crisis. And yet this I felt, here I was just months into the job. I started during the global financial crisis writing the Asian Pacific financial forecast. I was seeing what I felt was a massive bull market ahead in Indian stocks. And let's look at how that forecast, well, here's the analysis. I said the market, this is the exact chart I published at that time. The market is a fractal, and you can see a 5-wave advance followed by a 3-wave decline. It's actually not labeled ABC, but it's actually WXY, which is a variation on ABC. But we don't need to know that right now, because the point here is that it was a wave 1 up and a wave 2 down. And you can see what another feature of this was the self-similarity. Look at the spike down in that absolute crash during the global financial crisis in late 2008. Look at how similar that was in form to the up-down sequence here labeled wave 1 and 2 within the red box, right? Interestingly, that same spike down here, it reached the 50% retracement of the previous wave 1 high, just like this wave 2 reached the 50% retracement of the advancing wave 1, circled wave 1, primary wave 1 high up here. So this the self-similarity of this fractal pattern gave me the confidence to make the forecast. Here it was. Indian stocks are about to begin primary wave three of the bull market that began in 2003. And let's look at how that forecast has turned out since. This has been exactly as I was not. I mean, I can't say that every little squiggle along the way was exactly as I expected, but in terms of the larger progression, the long-term bull market forecast, it worked out very well. In fact, several months after the lows held in early 2009 and we started to advance, that gave me the confidence to go on to India's CNBC affiliate called TV18 and call for Sensex 100,000 within 15 years. That's the kind of forecast you can make, to great disbelief among your viewers, because everyone is still focused on the decline. They think that the Depression is on its way, and here I am focused on what's actually going to happen. And unfortunately, the year 2024, 15 years past that 2009 forecast came and went, and we came as high as 86,000 on the Sensex. That's, you'd say, okay, it fell short of 100,000, but that's pretty good. It's about as good as it gets from an Elliott Wave perspective in terms of accuracy. And I actually still am bullish. I think we're going to hit that 100,000, not because of 100,000, but because of the internals of this continued advance. And so it may just take a little longer than I expected, but we'll get there. So let's now look at some other examples of patterns that are relevant to gold and to commodities, and I'll show you why in a minute. This one's called an expanded flat. In the pattern, it's an ABC, a variation on the ABC pattern in which wave B of the pattern advances beyond the start of wave A slightly, and then gets crushed in wave C down. And some details, your viewers may be interested in if you appreciate such things. The Wave A is three waves, wave B is three waves, and wave C is five waves, 1, 2, 3, 4, 5 down. And now let's apply that to commodities, and we'll get to gold in a minute too. But here we have, at the top, the Bloomberg Commodity Index, and at the bottom, the U.S. 10-year bond yield. In February of 2020, I recognized that the pattern I'm about to show you was so clear that I was able to say, okay, the index is going to fall to the 60 to 64 range. Well, the actual bottom was 58.87 about 2 months later. And I waited for the price to advance a little bit because you never know. I mean, the truth is that in real time, trying to call the absolute low is very difficult. It's better to wait for a little bit, at least I feel, a little bit of upside to get a trend going the other direction. And then I came in several months later on September 2020 and said target reached, bear market over. And at the same time, I made this forecast for interest rates because I noticed that this pattern I'm about to show you, which started in 1980, actually began about the same time that this disinflationary trend in 10-year bond yields had lasted. And if you're going to end a commodity bear market, then you're probably also ending the entire disinflationary trend in yields. And let's take a look now. First, here's the price action. Oops, sorry. Here's the price action that's happened since, confirming what I was believing at the time. But here's the pattern. Let's look at this. Again, we were looking at the Sensex earlier. You had a five-wave advance, right? This typical five-wave advance from this 1962 low up to the wave one high here in 1980, followed by a three-wave decline labeled wave A, a three-wave advance to wave B high in a expanded flat correction, and then a five-wave decline to complete wave C down of the expanded flat correction, a 1, 2, 3, 4, 5. And this basically contributed to my bullishness down there. I basically was observing in yields that wave two may have coincided with a single disinflationary trend from record high interest rates to record low interest rates, implying enormous upside for commodities, price inflation, and interest rates in coming decades. So the price has advanced, the yields have advanced in line with that thesis. Can they come down in the short term? Yeah, actually at Elliott Wave International, whether prices go to a new high above that earlier high in yields, that may be possible, but the next big move in yields is actually going to be back down, and that may lead to a period of benign economic activity, but it will be the last blast before we enter a period of high inflation and high price inflation and high commodity prices, and that will extend this wave three advance that I'm calling in commodities. This is not going to last years. It's going to last decades. And here's the reason why. Here
Mark,
we have the,
could I
yeah,
just
go ahead.
ask you a question?
Sure.
'Cause a lot of the people that follow me or some of my friends think that bond yields might still drop. Any idea where it could go to in terms of level, like
Yes,
three and a
there's
half?
actually Yep. There's actually a very clear target from an Elliott Wave perspective on the 10-year, and that is 2.5%. And the reason for that, we could talk about later, is that is the end of the previous fourth wave of the advance. So I haven't labeled it here, but if we were to zoom in on this, you can see that there's a five-wave pattern under development. And the end of the previous fourth wave of that would be 2.5%. And that's exactly where the corrections again, at some point we'll label this as a wave one advance in yields up, and then we'll be looking for a wave two correction on the downside. And the end of that wave two often targets the previous fourth wave of one lesser degree, and that's what there it would be. So, but it'll be a blip in the screen as far as the long-term trend
Yeah,
is concerned. So,
and that will be the
um,
last chance to sell your bonds, I guess.
Um, I mean, yeah, I can't use those terms because I work for a financial publishing company. I'm not an advisor,
No, I
but
know. Yeah, we're not.
but
I'm
you
not
could,
an
yeah,
advisor either. Yeah. Uh,
yeah. But basically, yeah, that's what it implies.
okay.
And yeah, you may actually get a bond yield, sorry, a bond rally in the near term that would be worth riding. But that's again, I'm more concerned with the long term here, and I want to make an impression on you with this fractal relationship right here. You can see that this wave two decline, right, Roman numeral wave two over here, the ABC expanded flat correction, is very similar in form to the smaller wave two that we were looking at earlier over here. So here I have a wave. I didn't label it, but this is wave A, B, and C. And the similarity of form, just like we were looking at with the Sensex Indian stock fractal, is giving essentially allowing me to have even more confidence in this forecast. But that's the power of these fractal relationships. And so you can see that we've got here wave two is a fractal iteration of wave two of one. That's the language that we use. And to emphasize how large this wave three advance is going to be, we're now at the wave 100 level over here on the Bloomberg Commodity Index. And look where that same juncture is back here in this wave three advance, right? So it's taken, to get to where we are here, it's taken 4.5 years to get from 60 to 100. Here, back from this 1968 low to get to this comparable juncture here within this wave three advance, it took, if that's 4.5 years, right, comparably speaking, then to get to the end of this entire advance, this wave three advance, which would be comparable to this Roman numeral wave three advance, it's going to take decades. So it's this is all feeding into my macroeconomic view. Again, I think this is the proper way to do macroeconomic analysis is through fractal analysis, through Elliott wave analysis. So anyway, let's now make some forward progress and look for gold. The same um, expanded flat correction that we were looking at in the ABC pattern you can see playing out here as well. Wave B slightly rose against above the wave high. You can see I published this last year I'm sorry, not last year, 2 years ago, 2000, a little more than 2 years ago, 2022. Many people remember that juncture. It was probably devastating for a lot of people to see this decline in wave C. But with Elliott wave analysis, you have to expect that the bus is going to come to a screeching halt, reverse, and go the other direction. And in fact, that's exactly what happened. There was another clue that this wave, this C wave, was about to end. On a little clue I can give you is that wave C often equals wave A. In this case, the best way to calculate it was on a daily closing basis. This spike to the wave B high actually ended the day right there. And if you calculate that point, the height of wave C compared to the height of wave A in points, that's pretty much where it was pointed to right here. And guess what happened? We now know that that's prices reversed pretty much at that level and went in the opposite direction. We've had a 73% or so price rise since then. I imagine many of your viewers are curious as to what may happen in the future from an Elliott Wave perspective. And I have to admit, here we have at the bottom an RSI momentum indicator, and momentum has not kept pace, as you can see, as this divergence line indicates, with price. Has risen above the 2024 high, and yet momentum has held below its equivalent high. And that's often an indication that we're going to have some consolidation, a corrective period. Not It doesn't reliably indicate that, so I can't promise that it will occur. But here's an example back in early 2023. You can see that prices hit new highs above that early 2023 high, while momentum failed to keep pace. And we did head into a near-term correction over the next several months. And so I can't rule that out by any means. But again, I'm not even concerned about that. That any correction now would be a blip on the screen compared to the long-term trend that I'm envisioning, which we can see in this chart right here. I published this chart last year. It's both gold and silver back to the 50s. You can see from the 1952 low, both silver and gold have traced out an initial large wave one, we'll call it Roman numeral, or what we call cycle wave one advance to the 1980 high, then down into a second wave, cycle wave two lows. And then since then, they've been tracing out smaller wave twos, wave one and wave two patterns. Again, these are larger. Um, we saw earlier that Elliott waves are nested fractals, right? They sit inside of each other. And so these are developing at the same time. The larger five-wave advance is enveloping the smaller five-wave advances that are now happening you can see labeled here 3 degrees of trend, as we call them. The Roman numerals are called cycle degree, the circles are called primary degree, and the brackets are called intermediate degree, intermediate trends, intermediate degree advances. And so if we were to then apply these what everybody's very familiar with the dates and the turns in gold and silver, we can now then apply that to this pattern, which is called a third wave extension of a third wave extension. This is what I believe is operating in the precious metals markets. And if we apply the gold, for example, this is the 1952 low, the 1980 high, 1999 low, 2011, 2015, 2020, 2022. And if this analysis is correct, you are here within this pattern. In other words, gold has been advancing for nearly a lifetime, and yet this supercycle advance is not even halfway complete. And not only is it not only halfway complete, but it's about to accelerate in one of the fastest uh, uh, junctures within the pattern, what's called a third of a third of a third wave. In other words, all 3 degrees of trend are operating at the same time, and that's the point at which the prices accelerate, or in theory, that's where they accelerate. So this should be a very interesting several years immediately ahead of in gold, even if it does pull back for several months at a time in the corrective in a correction.
Just a
So yeah,
excuse
sure.
me. The number three in the circle there,
Yep.
what would you say that would be in terms of time? What year would that be?
Oh boy.
Or is a third of a third, is that, do you mean that the wave from 2022 to the next three? You're saying that that one is going to be a pretty big wave? Is that?
Yes, in theory, the middle of the middle of the middle wave
I,
tends to be the point of maximum acceleration, and
okay.
that's what is directly ahead. So this wave, I mean, wave three up here, right, which could last. I mean, at this point, I know a lot of people love to have time and price targets because it allows them to fixate on something. I have no idea at this point, how long this entire super cycle is going to last. Ralph Nelson Elliott made an amazing call back in 1942. He actually called the end of his, super cycle advance from the 1932 low, he said would be the year 2012, right? So that it was an excellent working target, but and I could pick a number out of a hat, but it would be absolutely meaningless, just like the year 2012 turned out to be. So it's at this point, let's just say let's double the if this has been a nearly a lifetime advance to the present, let's call it another lifetime before we get to the end of wave five. And that's why maybe some people alive and listening today may be lucky enough to see the end of the super cycle, but The point is that there's a lot of upside ahead for gold, and the best part of the pattern, the sweet spot, is happening right now, and this is why it's a great time to be invested in gold, a great time to be oriented in that outlook. So all right, so let's go now to the first half of my. If anybody's interested in the end of the infotech era, well, this is my reasoning for it. Again, I'm not just armchairing it and coming up with I think, well, if gold's going to rise, then infotech's going to fall. I may believe that, but here's my justification for it. Here's the Nasdaq 100 index. Here's a five-wave advance that began in 2002. And it has one, two, three. The wave three is long and strong as they tend to be. It's subdivided into five waves itself. And we're now in the fifth wave of that pattern. And I was talking earlier about how wave C often equals wave A in a three-wave pattern. And there's a corollary to the five-wave pattern in which wave five often equals wave one, either in price or in time. And so by that measure, again, this lasted from the year 2002 to the year 2007 to the wave one high. If we say that no, the wave four ended in 2022, and then if we add 5 years to that, that would give us an ideal top around 2027. And at a price level, I would say we've got at least 60-something% advance still left to go over that 2 year period before we reach that ideal topping point. But again, these are just idealized. It doesn't necessarily mean that it's going to happen. It could actually end at any time. And the same thing with Bitcoin. There's a five-wave pattern that has been developing in parallel. It's no coincidence that this support line is right here, because it's actually, if you were to draw a line parallel to this and draw it from the wave one high through the end of wave three high over here, that you would have a perfect trend channel. And I would just say continue to watch this uptrend line, because if we were to break down below it, well, that would be the beginning of the end for Bitcoin pretty much. And you would also have to look out for the potential of a trend line break in the Nasdaq 100 as well. These two asset classes do not necessarily have to top together. They may, but one could top even a year ahead of the other. I have no idea which one is going to top first. But when they do, you're going to see a very large and potentially deep bear market lasting, another lost decade, if not two, that these two asset classes will experience. So that's the end of the infotech era, and here is my thesis for the start of the era of emerging markets. You can see the relationship between the Bloomberg Commodity Index and the MSCI Emerging Markets Index is pretty. It's certainly not. The emerging markets stocks have increased far more than commodities have over the period. But the important point here is that the two asset classes tend to ebb and flow together with each other over the intermediate terms. And when you have large bull markets like you did during, from the 2003 to 2007, for example, emerging markets have gone along for the ride. So that's what I think is going to happen. If you now have a large third wave, cycle wave three advance that's going to last decades in the commodity index, well, I'm pretty sure that emerging markets are going to benefit from that considerably, considering the dependence that these markets have on commodities. And so another reason for my optimism is this ratio between, we're now not just talking about the direction of emerging markets going up, we're talking about outperformance versus the US stock market. In other words, this ratio between the MSCI Emerging Markets Index and the S&P 500 with a historical extension provided by Bank of America. It shows basically that over the past 15 years, the S&P 500 has just been crushing emerging markets in terms of performance, well outperforming it. But if you look over the long history of emerging markets have a long history of crushing the S&P 500. And it has done that during, especially during periods of commodity outperformance, and that is during the 1970s, and here we have the bottom in 1967, and outperformance lasting even into 1994, and then from 1999 and certainly after 2003 to the 2010 high, we had a commodity boom, and emerging markets did very well. So if you're looking for a little diversification away from pure metals alone, you may want to look toward emerging markets, and certainly I'll be covering that over the next 2 decades in my newsletter. So this is going to be an exciting time. And here's one in terms of timing. Why you could say, well, Mark, why necessarily is this ratio going to upturn now? Why is it going to turn up now? And I think I have a means of timing that because I believe I have a means of timing this indicator, which is the US dollar index. And you notice that basically the rise in the US dollar has been a pretty good indication historically of outperformance by the US stock market. It's a great indicator. And if you basically can time the end of the strong US dollar trend of the past 14, 15 years, you can basically time the end of this broadly, time the end of this the upturn in the ratio. And I think we can do that right here. Here we have the US dollar index. Again, this is, as many of your viewers, I'm sure know, it measures the strength of the US dollar or the performance of the US dollar versus a basket of developed market currencies. It traced out a 5-wave advance from 2008 to 2022, where I talked earlier about wave C equaling wave A and wave 5 equaling wave 1. Here's an example of wave 5 equaling wave 1. And it helped me to basically call the end of that advance here, ending in impulse in 2022. And we've since traced out an initial part of a correction as well as a counter trend advance, I believe. I think this is actually going to hold above, or rather below, these previous highs. And one reason why I believe that the U.S. dollar index is ending its uptrend is because of this index down here. This is Deutsche Bank's index of emerging market currencies, which have been declining against the U.S. dollar over the entire period that the U.S. dollar has been rising. This pattern is a beautiful pattern called a ending diagonal pattern. It's an overlapping 5-wave structure. Has it ended already? Could it go down a little bit more? Sure, it could. Has it ended already? Possibly. Either way, it really doesn't matter, but we're in the end game. And it's basically the US dollar is on its last legs. And I think that The Economist, many of your viewers probably remember this cover back in October last year. They called the US economy the envy of the world, and they chose as their symbol a rocketing roll of US dollar notes. And I think it was an excellent symbol because, as we saw, strength in the US dollar is actually a great indicator of strength in broader US assets. So, but in this case, I think, given the strong consensus against or toward the US dollar, I think we have to interpret it from a contrarian perspective. In other words, this is actually indicating the end of the strong dollar trend. So,
Yeah,
just
and
before, yeah,
we've seen, sorry,
sure,
Mark, we've
yeah,
seen
back,
over the
yeah.
years how publications like The Economist and even the FT, for example, I cut this out back in 2004. The FT said that gold was going gold, and it was at $400 an ounce. And here we are
Yeah.
at 2,900 anyway.
Sure. Yeah. Yeah, exactly. No, that's how, I mean, unfortunately, journalists are part of the same investment consensus. They pretty much believe what Wall Street believes, and they reflect that on their covers. So it's no different. If you look at what hedge funds are doing, they're buying into the dollar heavily right now, and or recently, and guess what? That simply gets pictured on the cover of financial news magazines. It's just a reflection of the same crowd psychology that influences the waves. And that's why, having knowledge of waves will actually help you to interpret the world around you. If you see a magazine cover like this, look at the Elliott Wave pattern to see if it actually confirms the sentiment. So it's quite interesting how that works. But very good observation about that call at 400 in gold. Um, okay, and one last pattern I want to discuss before we get to the last part of my thesis, and that is a contracting triangle. This is a pattern in which the prices get narrower and narrower until they finally break out to the upside. Each of the subwaves is itself 3 waves, A, B, C, D, E, and when I look at the emerging markets, there is one market in particular that I focus on as a likely candidate to lead the next uptrend, and that may make a lot of people uncomfortable, but that is China. Here we have an example of the Shanghai Composite tracing out a contracting triangle pattern. It actually ended back in February. And since then, it's traced out a series of first and second waves, as we say. In other words, wave one, two, and so on, just like we saw with the larger pattern in gold from 1952. But that's playing out in the short term in a very small degree in what we call wave five up. Triangles often occur in the fourth wave position of a larger five-wave pattern. So my working assumption is that this is a wave four low and that we're now rising in a fifth wave to all-time highs and beyond. And in addition, the currency, the Chinese yuan, it shows is also ending about a year after the stock market, a large bear market. And could it go down a little bit further? Sure, it could into sometime in 2025. Could it have already have ended in truncation, an incomplete pattern? That would be very bullish. That's also possible. So it doesn't really matter to me. The point is we're in the end game of this bear market pattern. And one of the things that I think is not recognized widely or given enough credence on Wall Street is that this is actually one of the stronger currencies in the world. If you look at where back here in 2008, right, this is where or in early 2008, mid 2008, this is where around the 7 level here, this is where the US dollar started strengthening against most currencies in the world. And yet, look at what the yuan has done since that time. It's barely given up very much at all, maybe, I don't know, 10% less. Um, and that's a very strong sign. It's called relative strength within the sector. So this is a relative strength leader within the currency sector. It's ending this bear market around the 50% retracement of wave two. And I think this is a very powerful pattern that will eventually lead to outperformance not only of in the Chinese currency, but also in the Chinese stock market. So it's definitely one sector to watch and one country market to watch within emerging markets. In fact, this chart I published in January, it shows it's an analogy between the yuan today, as you can see here, and it's basically a wave one decline and wave two, I'm sorry, wave one advance, a wave two correction. And I'm comparing it to the Japanese yen back in the early 1980s. Here you have the wave two decline. The yen had been declining for 4 years against the dollar, and yet it reversed on a dime, went the other direction. The bus came to a screeching halt and absolutely started accelerating. If you had bought Japanese stocks back in 1982, you would have absolutely outperformed the rest of the world over the next 8 years to the late 1989 high or so. And I think a similar, because not only were you riding a very, very strong stock market, you were also riding a very, very strong currency trend. And so I think that the yuan may do something similar. And it's definitely a market that you may want to consider if you're willing to stomach the volatile politics. Anyway, so that's the end of my presentation, and thank you very much for listening to it. This is an example of my newsletter. This is the February issue, the current issue, in which I feature the video as well. So if you want to go to elliottwave.com and check it out, feel free to do that. In fact, I
Yeah.
think, yeah,
And
Mario, I think you'll be presenting a link if in this YouTube video. Your viewers can just click on it. It will have a special message on our website specifically for Maneco 64 viewers. And thank you very much for anyone who does visit. And good luck with your gold investments. I'm sure you're in the right asset class at the right time. In fact, it's going to be a great several years ahead. But thank you very
oh,
much.
yeah, you're welcome. And what you said about China and the Yuan as well is interesting because we've been hearing a lot that China is going into a deflation, that it's going to collapse, but the waves are telling us something very different.
Yeah, it's a classic contrarian story. I mean,
Yeah.
and you'll begin to see. I think actually here I was, presenting my thesis about the rise of emerging markets and how China will feature heavily in that. I mean, it does dominate the commodity market, 50% of it. It's in the right place at the right time. But and then we see this news come out about DeepSeek, right? About how this is it's not really nothing. It's nothing new. China has been providing better value at a better price for decades, and this is just another example of that. But they're competitive. They are extremely competitive, and I think DeepSeek is just another example of that. You'll continue to see more surprises come out of China during its Wave 5. Roman numeral Wave 5 advance in the Shanghai Composite. It's going to be a great time to be a China observer and perhaps even an investor in China.
Great, Mark. Thank you for coming on, and we'll keep an eye on things, and maybe if you want to come back, let me know.
Sure, we can do an update every however off you'd like.
Great,
So
thank you.
we have you back. Yep. Great.
Take care and enjoy Brazil.
Okay, thank you very much. All right. Have a good day.
You too.